Hi, Bill Bodner here, Mortgage Market Guide. Thanks for tuning in to our MMG Weekly Recap. So here we are up on the screen, another week, another decline in home loan rates. Touching down, I think, the 3.99, the lowest since January of 2018. But what was interesting this past week is the disconnect, and we mentioned it in our MMG Minute earlier this week, the disconnect between the gains seen in the Treasury market as well as the gains seen in home loan rates. And so the Treasury market, what we watched the yield on Wednesday, declined to the lowest level in 20 months. And so, certainly we have seen home loan rates, the average, go down to the lowest since January 2018. But if we take a look at a chart of mortgage-backed securities, heck, we haven't even made a closing price high for 2019. And why? Well, remember that when there's unrest, global unrest, the things this week is obviously U.S. and China and the trade, no resolution, even escalating tensions, things slowing in Germany and in Europe. What happens is global investors seek a safe haven and they flee into the U.S. dollar. The U.S. dollar has been rallying like crazy. And that means they're getting into the Treasury market. And so we're seeing what we could say are outsized gains in the Treasury market. So we watched the yield on the 10-year note decline sharply, whereas mortgage rates, yes, they improved, but not nearly as much. And the gains are not in lockstep with the Treasury market. So you need to be mindful. And we talked about that in our minute yesterday. Be sure to share that with clients because you're going to see the notes out there. Hey, the 10-year note hits 20-month lows. Well, we're not 20-month lows in mortgage rates, at least not yet. And so a couple of things we're watching. Number one, moving sideways. I like that we're staying above the 50-day moving average. The technical picture is pretty sound. But again, we still haven't made a new high, which is something that at least has our attention. In the stock market, we're watching the S&P 500 try to maintain itself above its 200-day moving average. On Wednesday, it bounced beneath it. They showed a reversal candle. We'll see if prices can kind of hold here in the stock market. If so, it could take some of the tailwind out of the bond market. But I think the biggest story to follow here is what's going on with U.S. and China. We're 1 month away from, I guess, ongoing or deeper talks that's going to be at the G20 meeting. But any headlines that come out in advance, negative or positive, could have a big effect. And so it's the biggest news. Frankly, it may determine whether a recession in the U.S. or around the globe comes on quicker. I mean, right now, some of the data hasn't been great of late. That's another reason why rates have started to decline. Retail sales was recently. Durable goods was but consumer confidence remains high. So people feel good because the labor market is tight. Wages are rising. And, a lot of people are also sheltered from sun and noise. But if the trade war or turmoil escalates, it will have an effect on the economy, and I think that we will move another leg lower still. So listen, rates are going to be phenomenal for the foreseeable future. Inflation we're seeing disinflation, which means actually the rate at which it's increasing is declining. That is supportive of long-term rates. We have this turmoil, this trade war that looks unresolved. Anytime soon, that's going to give us a tailwind in the bond market. So for right now, you're talking to clients. I would not be looking to lock clients brand new in the door or anybody with more than 40 days to close. Certainly new construction, those, I think you should be watching them and just watching the technical picture. But if you get loans that are closing inside 30, 40 days, this is a pretty clear limit to the gains we've seen in the mortgage-backed security market. If we break above this peak, all bets are off. We're going to move another leg lower in mortgage rates, but we're just not seeing it yet. So anyway, another big report. We have the jobs report next Friday. So I think the news items are going to take a back seat, generally speaking, to the U.S. trade negotiations. But the jobs report, the big one, that's next Friday. So that will be a time. We'll see where we are technically next week and position ourselves in advance of that release. Hope this finds you well. Have yourself a great weekend. We'll be back soon. Bye for now.